Hello, Sarah Nash here with Foundation Financing. Today we are going to be talking about MCAs or merchant cash advances. I do have another short video on this topic, but today we're going to go into details and specifics. So just to briefly recap, these are not actually loans. Just as the name implies, it's an advance. It is an advance on your business's future revenues. That said, they are very easily attainable, but they are expensive. So let's talk about that. Easily obtainable, so what are the qualifications? Well, believe it or not, a business owner can be considered for one of these advances with a FICO as low as 500. So even really blemished credit can be considered for these. The exception to that are open bankruptcies or open tax liens. Other than that, pretty much any credit is going to be considered. Additionally, very short time in business is also considered. So if you have as little as 6 months and sometimes even as little as 3 months time in business, you can still be considered as long as you are generating revenue. So that's the big factor that's considered for this, of course, is the revenue of the business. So on average, a business must be generating consistently $20,000 a month. The rule of thumb for these is 80% of your average monthly revenue is the amount that's advanced. So, for example, if your business is generating on average $30,000 a month in revenue, the advance amount would be $24,000, 80% of 30. That all said, the documentation for these is fairly minimal as well. So in order to get a qualification, all that's needed is an application and bank statements. If you have at least 6 months time in business, then 6 months bank statements are all that's generally needed. If that business is 3 months, then that's all that's needed for the consideration. So again, easily obtainable, expensive. So how expensive? Well, because these aren't loans, there's actually not an annual percentage rate assigned to the advance. Instead, it's something called a factor rate. These factor rates are generally between 1.20 and 1.60. What that means is that your repayment is 120 to 160% of the total taken. So let's use an example. In this example, we're going to say that the factor rate is 1.40 and the term for repayment is 6 months. So that means that 140% of the amount borrowed, or the principal plus 40%, is the amount that's repaid over a term of 6 months. If you take that out to a full 12-month term in order to figure your annual percentage rate, that's 80%. 80% annual percentage rate is very, very expensive, just as stated. The interest is also front-loaded on these. What that means is that day one, when you take that cash advance, your interest is actually added right onto the principal itself instead of amortized over time. The good news is if you repay before the full term, oftentimes you do get a discount on that front-loaded interest. Make sure you read your contract. That way you'll understand truly what the rate is, what the term is, and if there is an opportunity to save money if you prepay. If there is not a prepayment incentive within the contract, ask your lender. Oftentimes they can add an addendum that allows you a little bit of a discount if you pay it ahead of the term. So when is this the right fit for businesses? Because oftentimes it's not. There are some situations though that the benefits outweigh the drawbacks. In a situation that your business has a great opportunity and needs money very quickly, this could be a good fit. If you have an investment opportunity but don't have cash on hand, this money can be deposited into your business's bank account in as little as 48 hours. So it's really, really quick. Another situation it might be right for is a very short term. So again, short-term loans, generally less than 12 months. And if you're going to be paying it back before the term, then you can end up saving some money on it. Another obvious situation is poor credit. So again, FICO as low as 500. If you've got very blemished credit, this might be your only option. That all said, whether you're considering this because you need money quickly, you're paying it back quickly, and or you have poor credit, always consider your return on your investment, as with any time that you're borrowing money from your business. If your cost of your capital is more than the return on that capital, of course it doesn't make sense to take this. So make sure you really understand what you're getting yourself into and how much money you're going to be making back on it. And again, read the contract. So If you are in a situation that you've already taken a merchant cash advance and you're sitting there thinking, well, this would have been great to know 3 months ago, don't worry, there are options for you as well. You will see a description below this video that has a link to a section of our website that can give you a bit more information on how to either settle or modify an existing merchant cash advance, and we can absolutely help you in that if you are in a situation where you're in over your head or can't make your repayment. Additionally, in the description is a link to the education portion of our website that has additional videos, blogs, and a lot more information about business lending in general. So I hope this was helpful. I'm always here to provide that extra knowledge for my fellow business owners, and I look forward to speaking with you next time. Take care and thank you.